All right, hello everybody. Thanks for tuning in. Just want to go through a little bit of analysis here on the S&P 500. So, I think it's important to understand that the S&P 500 is the 500 stocks, right? Says that right in the name, so that shouldn't be a surprise. Also consists of 11 sectors. So, one of the things we used to do back when I was in my institutional trading days, the morning meeting, we would kind of go through the sectors just to see what's going on, see if we could find some insight for trading ideas. And you know what? The former hedge fund trader stuff is so overdone. Blah, 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 blah. Okay. I was a head of trading at three different institutional money managers where we had hedge funds as products, we had mutual funds, we had other things. So, yes, I was a former hedge fund trader. But guess what? There are hedge fund traders who suck, and there are hedge funds that go out of business. So, just because someone was a former hedge fund trader, and I know it's pretty darn ubiquitous these days, it doesn't mean that they know their you know what from their elbow. Okay. So anyway, let me just get that out there. Oh yes, I was a market maker as well. How about that? Yay me. All right. Anyway, here's our S&P 500. Okay, we're going to look at the spider here, which is an ETF that's designed to track the S&P 500. It's called SPY because that's the symbol, and it's an ETF, and Spider is S&P Depository Receipt or Standard & Poor's Depository Receipt. And these things are run by State Street Global Advisors. So what you can do if you want to get more insight into some of these ETFs is come over to the State Street Global Advisors website, and you can see what's going, give you a little bit more insight. So you just type in SPY blank SSJ and it'll bring you right to this. Now, here's the S&P breakdown, and we have our holdings. We can see that Apple and Microsoft and Amazon and Google are big weightings here. Here are our sectors. Different sectors drive the S&P 500 at different times. Different things are in the driver's seat at different times. It was tech up until, I don't know, 2 or 3 weeks ago. Maybe tech's getting back involved now. Sometimes it's financial, sometimes it's consumer discretionary, sometimes it's consumer staples. Usually utilities and materials and real estate, they don't really play that big of a role because they're such small parts of this. Energy is only 4.3%, but energy can influence the benchmark because every company needs energy regardless of what they do. So sometimes even though it's only 4.3%, energy can be more impactful than it seems like. Utilities, but they do give us some insight into interest rates. Consumer staples, pretty small, but sometimes when money flows into consumer staples, it tells us that there's this like flight to safety going on. People are selling the stuff that they perceive as being more risky and buying things that people perceive as less risky. I'm not so sure that's the case all the time, but part of being a trader in the institutional world, oh yeah, I was a former hedge fund trader, blah, 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 is understanding what's driving the markets. So here we have our S&P 500, or we have our SPY, I should say more appropriately. We've been talking about this 430 level for a while. It was resistance back here, and over the last week, it's been resistance, and this is pretty much where we stalled out on Friday, 40 or 429.90. You can't get much closer to 430 than that. Okay. Now, you might ask yourself, well, gee, Mark, hey, well, if you're asking that, you're asking me, you're not asking yourself. But you might be saying, hey, Mark, how is it that there's resistance at the level that was resistance before? One of the most important things you need to understand about financial markets is that some price levels are more important than others. That's just how it is. Sometimes we understand why these levels are important, and sometimes we don't. As a matter of fact, most of the time we don't. But we just need to know that they're there. Why is 430 a resistance level? Well, there are people who bought SPY back here around 430 back in August, okay, coming up on almost a year ago, that regret doing so. They thought they made the right decision. The market was going higher, but then it goes lower, and they tell themselves, "Man, I made a I made a bad move here. I'm going to sell if it gets back to my level because I want to get out. But I'm only going to get out if I can get out at break even. So they place their sell orders around 430. Okay. So when the market gets back to 430, you have remorseful buyers placing sellers. And if there's enough of them, the level that was resistance can become resistance again. You can see on the chart here, right? There's other important price levels like here. Resistance here became resistance here. In the institutional world, aka the hedge fund world, right? And listen, I know people that trade different styles, different funds, whatever, that are good. Just because someone says, "Oh, I'm a former institutional," or I mean, sorry, a former hedge fund trader, big effing deal. Okay, I really don't care. It doesn't do anything for me. This is kind of interesting here too, right? Something to look at. 450. This is like the 416 level. Notice how support here became resistance here. When the market's going lower, there's not enough demand or buyers to absorb all of the supply or sellers. So the sellers are forced to push their shares out at a discount. And as a result, we it forms a downtrend. When we get to a support level, for whatever reason, and I don't know, I don't need to know, I just need to watch. When we get to a support level, there's enough demand to absorb all of the supply. So the sellers can sell all they need to, and then the market ends up rallying. Now, why would support here become resistance here? Well, it's the same dynamic, but instead of resistance becoming resistance, support becomes resistance, but it's because of the same thing. It's because of buyer's remorse. There are people who bought here who regret doing so when the price goes lower, and they tell themselves, gee, if I can get out at break even, I'm going to. I made a mistake. So if you have enough remorseful buyers placing sell orders at the level that was support, it becomes resistance. Now, notice this. What was resistance becomes support. Actually, let me rephrase that. Support here becomes resistance here again. So these important levels can stay intact for a while. So let's go back to here. The biggest sector in the market is technology. The technology sector, SPIDER, or ETF that follows this part of the market, remember there's 11 sectors, is symbol is XLK. And now look at this. Once again, we see this importance of levels. Notice how support here became resistance here. People buy here. They thought they did a great thing. They thought they were like the new Steve Cohen when the market went higher, blah, blah, blah. But then the price goes lower, and a lot of them tell themselves, hey, I made a mistake. I need to get out, but I'm only going to do so if I can get out at break even. So you have remorseful buyers placing sell orders at the level that was support. If there's enough, it converts into resistance. Let me say this again because I can't say it enough. There are certain price levels that are more important than others. That's just how it is. If you're trying to trade and you don't know where these price levels are, well, good luck to you, man, because you're going to have a hard time figuring it out. Knowing where the levels are is like a map, all right? You can even see here, there's stuff on the chart here I didn't put here yet. Like notice here, resistance here became resistance here. This is the same thing, buyer's remorse. Now, how about this? And this is what we really need to focus on. And this is going to be really important over the next week or so, okay? Next few days, next week or so. Could be a slow week. Don't forget, next Monday's a holiday. Let me just get rid of this to make it easier to see. Notice here, resistance around let's call that 130, became support here. Why would a level that was resistance turn into support? The answer is seller's remorse. People sold, price goes higher, they regret doing so. They tell themselves they're going to buy their shares back if they can get them at break even. So if you have enough remorseful sellers placing buy orders at the level that was resistance, resistance can convert into support. Seller's remorse is a common thing when the market goes higher. And you don't need to be a former hedge fund trader to know that. Market's going higher, people that sell regret doing so because it goes above the prices that they sold at. Here we have resistance becomes support. Resistance becomes support. When resistance becomes support, it sets the stage for the next leg higher. Markets don't go in straight lines. They go in like a series of like steps, like stairs. All right. And the current stair is higher than the one that was before it. And what was resistance in the prior stair step or whatever step on the staircase becomes support. So now that brings us to a critical junction. Okay. This level was resistance, and it was resistance a while ago. It's over a year ago. Well, yeah, over a year ago, about 18 months ago or 16 months ago. Markets, important levels can retain their importance for a long time. So this is the most important thing we need to watch to see what's going to happen with SPY. If this important price level for the tech sector, or XLK, converts into support, it'll set the stage for another move higher. And so far it has. So far it has. I mean, unfortunately, as a trader, you need to be have patience. I mean, I know a lot of people, aren't patient. I'm not patient, but you just have to be. You have to wait for the market to give you a clear signal. One of the reasons why people lose money is because they feel as though they always need to be in the market. They always need to be involved. And that's just not the case. One of my favorite quotes I've ever heard from a great trader is a guy named Jesse Livermore, who is a big, successful, what would be nowadays called a hedge fund back in the 1920s, maybe the 19 teens. And what he said is, I didn't make my money by being in the market. I made my money by being out of the market. And that's, to me, is really a brilliant statement. And what he is saying is, I was on the sidelines until I saw something that was compelling. You don't always need to be in the market. It's okay to take a day off. If you lose money one day, it's okay to take the next day off to get your head clear. If you make money, it's okay to take the next day off. As a matter of fact, I would recommend that. People that have really good days where they really make a lot of money, in terms of whatever, I don't want to give any numbers, but sometimes it goes to their head and they start to get overconfident. So if you have a really good day, sometimes I tell my students, like, hey, dude, just okay, let's take a day off, get back to chill, enjoy your day off. But remember, the market is a hideous bitch goddess. Once you think you got to figure it out, it's over. The best traders are confident, but they're not arrogant. All right, let me go on to, I just want you to take a look at the industrial sector. And I want to explain why things can sell off of resistance levels and rally off of support levels. Now, remember, if you look at a chart the right way, what you're looking at is a graphical illustration of human psychology and supply and demand. Forget what they're saying on CNBC. Forget what they're saying on Fox Business News. Forget what the latest, chat room guru is saying. Whatever. 99% of the time, they're wrong. Why would a market sell off when we get to resistance like happened here? And happened here, and happened here, and happened here? Well, resistance is a large group of sellers who are looking to sell shares at or around the same price. When the market's rallying, there's not enough supply to fill all the demand. All right. So buyers are forced to pay a premium, which forces a uptrend to form. They're forced to pay up, and that pushes the market higher. When we get to resistance, there's enough supply or sell orders to fill all the demand. Some of these investors who want to sell, they're watching the market trend, and all of a sudden it's like, oh, it's not going higher anymore. Gee, maybe there are other sellers coming into the market. So they start to get anxious or worried that they're not going to be able to sell their shares, because the buyers are going to go to who's ever willing to have the lowest price, who's ever willing to sell the lowest price. So sellers get anxious that they're going to miss out. So they start to undercut. They start to offer lower prices, like, oh, it just traded at 103.50. Well, you know what? I'm going to sell 103. Someone else says, oh, this person's going to sell 103. I'm going to go to 102.50. And it starts this cascading effect, or this snowball effect. All right. Why do we sell off of resistance? It has nothing to do with the default sailing. It has nothing to do with, whatever else they're regurgitating out there. It's market psychology. Market psychology is what drives prices. We have investors that are getting anxious, so they start undercutting each other. Now we have the exact opposite dynamic down here. When the market is moving lower, there are investors who want to buy, who are saying, this is trending lower, but all of a sudden it's stopped trending lower. Gee, there must be other investors coming into the market that want to buy. So if I want to buy, I may need to increase the price I'm willing to pay, because the seller is going to go to whoever is willing to pay the highest price. So you get a snowball effect from the other side. Coming off resistance, coming off support, it's market psychology. You need to understand that the vast majority of traders lose money, or newer traders, I should say, lose money because they don't understand the psychology. They think that the great traders, people that are successful, like myself and a lot of people I work with, have these secret systems or these secret models that are infallible. No, that's not the case. The best traders lose money. All right. They lose money, but the great traders understand what we're looking at as psychology here. Now, just to kind of bring this to more of an interesting level before I get going, but please make sure you check back with Stock Market Jobber because I'm going to try to go over this every day. This is a sector. All right. We're looking at the entire sector. This sector consists of maybe 50 or 60 stocks. I don't even know. If this sector looks weak, like it's coming off of resistance, or it looks like it's going to rally, if it's coming off of support, well, this is the aggregate. So within this aggregate or this average, there is going to be stocks that look like they're going to come off more, or they are going to come off more, stocks that are going to rally more. So we can go back to our fact sheet and we could look up. Remember, we're looking at the spiders, Standard & Poor's Depository Receipts, and it's run by the State Street Global Advisor. So let's just type in XLISSGA. This is going to show us the stocks that are within this sector. These are the top 10. I mean, there's a lot more. But if the sector looks like it's going to bounce, what we do here at Stock Market Jobber is we look at these various stocks and see what's going to bounce the most, or what looks like it's going to bounce the most. Looks like it's going to sell off. It's the opposite. I'll just bring up one or two things. I don't know. I like railroads, so I'm going to bring up Union Pacific. So let's take a look. The important thing is to understand that different parts of the market drive it at different times. Oh, look at this. So this looks pretty interesting. Now, if XLI gets back up to that 103.50 level and starts to go lower, there's a really good chance that this is going to go lower too. And there's a really good chance that on a percentage basis, this is going to move by more. So watch the sector to get insight into the stocks. Watch the sector to get insight into what S&P is going to do. The best traders don't guess. They let the market tell them what to do. And they understand that this is all psychology. Just think about this before I get going here. All right, I hear my wife yelling at me for dinner. Why on this particular day was Union Pacific up 2.6%? It's a huge company, $122 billion in market cap. What made it gain 2.6% in one day? Did they come up with a new super secret railroad? No, they didn't. It's just investor perceptions. And what bothers me is if you watch the media, they try to attribute every little move to some kind of fundamental thing that's going on. And that's just not how it works. It's psychology. Why would Union Pacific be worth the exact same price here as it was back here? So, all right. So today, or Friday, was June 9th. Exact same valuation as June 7th. Exact same valuation as May 22nd. Exact same valuation is going all the way back to here, March 9th. All right. Remember, the best traders let the market tell them what to do. When you look at a chart, you're looking at a graphical illustration of supply and demand and investment psychology, at least if you're doing it right. All right, everybody. Thank you so much. Please check back, and I hope to talk to you soon.